Hey trader, Stephen Kwitzel here with thetradersplan.com. Normally I shoot this Thursday after the close and send it out to you on Friday. We're still got a couple minutes left in the market on Thursday. I had to do that because I have some family obligations I have to attend. So I apologize for that. But I mean, looking at the market, there's definitely some distribution in the market. But you know, if this is where the day starts, actually let's go to the NASDAQ. You know, it fell off a map, kind of did a little double bottom, and is starting to come off the bottom. So I'll be very interested to see where the market closes today, because no matter what environment you're in, it doesn't matter where the market opens, it matters where it closes. So if I'm in a bull market and it starts weak, I want to see a strong finish. And in a bear market, or when the market's starting to correct and you have lots of days where the market starts up and then finishes down, then you know that typically gives me an early warning sign that at least maybe a mild correction is coming. So I'm not calling for a bull market, but let's go, and we're going to look at a lot of stuff today. We're going to look at the indices, we're going to look at some secondary indicators, some commodities, lots and lots of charts. I have a lot of charts and some lessons to go through today. We're going to talk about the Chinese IPO market because I'm seeing lots of them. I'm seeing lots of Chinese IPOs, and some of them have really, really good fundamentals. But I want to make sure that, you know, we talk about proper entries to make sure that you aren't just jumping on board, because these things, when they move quickly, and that's to the up or downside. So we got to make sure we protect ourselves. So let's just start with the NASDAQ. Actually, I want to start with my NASDAQ. Nope, not that chart. This chart. Okay. So, you know, still nothing has really happened. The NASDAQ is down about 1% today. But you can definitely see a difference between this uptrend and this uptrend. You've heard me talk about personalities. That's nice and neat. Pull back, and then the breakout, and then it's just kind of a little sloppy. And you know, what I learned from IBD, Investor Business Daily, is, you know, they count distribution days, and that's a day that's down 0.2% or more in volume above the previous day. And I like to really look at the above average volume. So there's a lot of tugging and pulling. You can see some accumulation days as well. That's great. But there's a lot of tugging and pulling in the last week. So I'm just really keeping my eye on it. But then again, it still is within 1.5% of an all-time high, so there's really nothing to be bearish about. But if you have some money to put to work, I think the market might come to you a little bit better than buying on a one down day. S&P 500 is definitely in better shape. It's been smooth for most of this ride. Looks a little better than NASDAQ. You have more accumulation days at the bottom. So, you know, I was talking the other day, this is a nice boring uptrend, right? You definitely should have made some money. As we did at the Traders Plan. You know, we made a lot of money. We took some profits on the way up, and we're sitting on a lot of cash, so which normally I don't like to, but I can't help it. I took a lot of profit on the way up, so I have a lot of cash to deploy, but I'm kind of waiting a little bit, trying not to get too impatient, and kind of letting it come to me, because I feel that the market probably will pull back to the 50-day moving average. So that would give me a little bit lower prices on some stocks. Russell 2000 definitely looks uglier. And, you know, I really wouldn't put too much into this. Now, you want small caps to outperform, right? Like this was like a 16% move in the small caps. And I drew this last week, and I talked in my webinar last week about how ugly it's starting to get, and it got uglier. So strength follows strength. Typically, weakness follows weakness, but we are in a bull market, and it did pull back to the 50-day moving average. So maybe it's going to revert to the mean. I don't know, but you know, just kind of keeping an eye on it. But one thing I've noticed, the Russell 2000 for the most of the year, really until August, has done nothing, while the small caps and NASDAQ has continued to outperform. So the Russell 2000, the small caps can have a mind of its own. That way, if it starts to drift, I don't read too much into it. I take notice, but if small caps start to underperform, I don't say, "Oh my God, this, you know, Chicken Little, the sky is falling." I just kind of watch it, and then if this large caps start to break down, then that confirms it. So I almost use small caps as a secondary indicator, but I do watch it closely. So speaking of secondary indicators, we looked at this last week, and this is the S&P 1500. And you got the S&P 500, the mid caps, and the small caps in these bottom windows. And I took notice that the market breadth peaked around October 1st, and the market continued to move higher. So when the market moves higher and the breadth is moving lower, and what that means is the fewer stocks are pushing up the market, you want to take notice. You want to pay attention. Again, the price trumps everything, and I literally mean everything. So you're paying attention to the price and the volume, and if the secondary indicators start to deteriorate and then the price and trend lines break, then you need to respect the secondary indicators. They're called secondary for a reason. Price is the only thing that matters. But when I see the secondary indicators, you think of yellow flags, a yellow stop sign, you might want to be cautious. And then when you see a breakdown in the market, then you're like, okay. So you can, slowly. I just typically use the yellow flags as maybe I should lighten up on my new trades, but that doesn't mean I'm going to just abandon ship and get rid of everything. So the small cap 500, 73% of small caps are still above the 200-day moving average. That's still incredibly bullish. I don't care if this is slowly drifting lower. That's bullish right there. So we're in a bull market. The breadth is still bullish. It's just kind of not really going higher with the market. Mid cap is starting to deteriorate a little bit more. You can see kind of the slope at 66%, still bullish. And small caps are pretty close to entering correction mode. If they go below 60%, which they're at 61, I would say they're in correction mode. So small caps usually lead to the downside. So I'm paying attention, because if this just falls off a map, I would assume that large caps would follow, or at the very, very least, take a breather, excuse me. So just something to take note of. It can be a leading indicator, but it is a secondary indicator. Something else I noticed today, and a guy that I follow, Arthur Hill on Stock Charts, he sent out a chart, with the high yield bond market. And he said, he made notes that the high yield bond market, it looks like it's rolling over, which could be a leading indicator for the stock market. And then I looked up at CNBC, and they were talking about the high yield bonds rolling over. And normally CNBC is just background noise to me because I work alone, but so I don't really take their advice. But it was just kind of interesting. You could probably say that if I drew a trend line right here, that trend line is broken. Actually, let me do that real quick. Let me kind of see what that looks like. So if I drew, this trend line, you could draw it here, you could draw it here. No matter which way you look at it, it's broken, right? So that's something worth noting. And in John Murphy's book, Intermarket Relationships, he does a really good job of explaining how bond yields work, and how the bond market, commodity market, stock market, and how the dollar and currencies, how they all correlate with each other, whether it's positively or negatively. So he does a really good job with that. If you're a nerd like me, I'd go buy John Market's Intermarket Relationships book. And it's an easy read. It's not overly complicated. But what they talk about in this book is how the bond market's typically the first to go. So when you have a market correction, and again, this isn't saying it's a bear market, we're in a significant bull market, but the bonds typically fall first, stocks follow suit, bonds usually bottom first, and then stocks go last. So you have stocks that towards the peak of a stock market, that's when commodities start to rally, which we have seen. Commodities have been rallying. Bonds typically roll over first, then stocks. So it's and it's not every single year, and you have different scenarios that could decouple these relationships, but just something worth taking note, right? If you've been following the market, I'm sure you've heard people say that the bond market is smarter than the stock market. I don't know, but we'll see. But this is just something, again, kind of you want to look at a collective weight of evidence, right? You want to take all the evidence and say, okay, what's reasonable to assume, right? So if you have the bond yields, or the junk bonds are rolling over, and if you have the market breadth get a little uglier, and then you have the stock market start to break its 50-day moving average, then it's very reasonable to assume that we could go into a deeper correction instead of just a 3% pullback. So okay, I want to go back to this chart because I like it and there's a lot on it. So last week I showed you this chart I just created. You got the S&P versus commodities relative ratio, and I talked about commodities can underperform for a long time and then outperform for a long time. So when this ratio goes up, it means stocks are outperforming commodities, and when the ratio goes down, it means that commodities are outperforming stocks. So when this trend line breaks, and it could curl, but we'll see. The trend line hasn't broken yet. The trend line would be around here. But that could mean a significant period, 5 to 7 to 10 years of outperformance in commodities versus the S&P 500. So I'm really trying to pay attention to that because if you have significant period of where commodities outperform, you want to be overweight international stocks, you want to be overweight commodities, and it's okay if the S&P 500 isn't doing great because you have plenty of opportunity out there. So the S&P 500 versus world stocks, you can see that the trend line is already broke. Right, so world stocks are already, S&P 500 is, when the line is going up, it means the S&P 500 is outperforming world stocks, and the trend line broke, means I just rebalanced into my long-term money into some world ETFs and got out of stocks. And this is just a relative ratio, meaning if this ratio is going up, it means that the S&P could only be performing world stocks for 2 to 3% per year. So it's not saying it's significant, it's just saying it's outperforming it more, okay? But I want to be in the leader, not the laggard. So the dollar and gold are very interesting, and I'm just kind of keeping my steady eye on it because you can see, in this pane, the dollar for the most part went down from 99 to 2011. The gold went up. And then you have the dollar going up and gold went down. Well, now you have gold that broke this trend line, and you have the dollar that could be breaking down, broke a trend line, but is looking like it wants to curl back up. So I'm really, this is probably the relationship I'm keeping my eye on the most, because if this breakout holds and if this breakdown holds, imagine the trend line there, it could be significant outperformance for the gold, for a very extended period of time, and then you would want to be probably extremely long gold. So it's just something, another thing you want to keep your eye on. I don't know what happened there. Let's look at some, actually let's look at some gold, speaking of some gold. So you have the GDX, I'm looking at gold miners. You have GLD in this window pane. You had the little head and shoulders, you have the breakout of a downtrend, and then it came down, and it's not an exact science, but it came down and it tested this support and is looking like it's wanting to curl up. So if this is a false breakdown, okay, so it looks like it's going to break down. If it's a false breakdown, one thing I've learned from Martin Pring, he says false breakouts or breakdown typically means a above average move in the opposite direction. So if this holds and it's a false breakdown, it could mean an above average move for gold miners. And you look at GDX right here, you have this downtrend. So I'm looking for the breakout in GDX. It is knocking on the door, but it hasn't done it yet. Because you can see that it broke out of this major downtrend. It made a move up. Now it came down. This is kind of a call that I like, that I made a few weeks ago. It broke out and it came down and it tested support right in here. You had every reason to believe that this would hold. However, I decided to avoid this trade for multiple reasons. One, the dollar, and this is the dollar right here, the dollar was looking like it was bottom and breaking out, which is telling me if the dollar is going to break out, little mini head and shoulders in the dollar, that means gold is probably going to roll back over a little bit because they have an inverse relationship. So that's one reason why I was hesitant on the trade. Reason number two is I went and looked at some of the strongest gold miners out there from a relative strength ratio, and when I feel like a industry has bottomed, I want to look at the top stocks in that industry, and I better see some accumulation on the chart, some accumulation on the daily and the weekly chart, and I didn't see it. I went to the top 5 stocks. I didn't see any accumulation, which there should have been if this was real support. So I passed on the trade. It popped and then rolled over, so I was right. But now it's getting a little interesting. Now you have the double coming out of a double oversold, right here, which you know I like. I like the double oversold because that's the extra shakeout to shake out the weak holders. Everyone who loaded up right here probably got stopped out, and now we're looking for this breakout. So it's coming out of the double oversold. It could potentially break out. The dollar at the same time could break this trend line because this could be a counter trend rally if it rolls over. And I'm looking at some individual gold charts. They have some accumulation in them, which is giving me a lot more confidence if this breakout happens. So again, you look at a collective weight of evidence to see, and I love double oversold because that just means somebody's already got shaken out. And that means more for me. And this is the GDX to GLD ratio. It means if miners is outperforming the metal, and you can see that ratio broke out. It means miners are outperforming the metal, but it kind of drifted backwards. So this, I think, this has to curl up. Now, you don't have to have the stars to completely align to take a trade, or else it might pass you by because some of these indicators might lag a little bit. But I think there's more evidence than not to say that this breakout could work, or if it breaks out, it could at least hold and trade sideways for a while. So that's gold. That's my long spiel on gold. XOP. Okay, let's look at oil. You have oil that broke out above this support level and is looking bullish, right? This is West Texas Intermediate in this window to 57, so it broke out to a 52-week high at least, and it's pulling back a little bit, which is fine. This is XOP, the Oil and Gas Exploration and Production ETF. The traders plan, at least the paid members, we traded this. And now I want to kind of walk through it. You can see right here that it broke out of this long downtrend, went up, created a bull flag. That bull flag failed. However, because it kind of came down here, came down and it reversed. Several things happened. One, it found support at the 50-day moving average. Two, it reversed 2 days in a row. You can see 1, 2, right around the 50 to 61% retracement level. And 3, what I like to do is it came out of the double oversold zone. So it came down here once, fake out, came out here twice, and then boom, came out. So we took a trade right here. We sold some right here. We sold some right here. And now it's looking like it's easing a little bit. I have energy on my short list. Let's look at another. So now we're going to go into some charts. We're just going to look at some charts. I just want to kind of bring some to your attention. Out of nowhere, I was just going through a bunch of ETFs. I noticed this Uranium. I don't know. I hadn't really looked into this. I don't know what's happening here, but let's kind of turn this into a weekly chart so we can kind of get a bigger picture. Man, that's a pretty big candle right there. And you can see one happened right here. And then it kind of created that flag and then went up. I'm not saying it does this kind of parabolic move, but I mean, there's going to be some volume that closes before the end of the week. You have this reversal right here. This is a weekly chart, but this is something worth taking note in the URA. V and Q. Actually, you know what I want to do? I want to bring up my MarketSmith. Okay. All right. So, I like to look at things that look like they could be on the cusp of, a potential reversal, right? I like to try to get early in the move. Look at REITs. Let's just look at the just basic REIT ETF for a second. This is the weekly chart. It has been consolidating. This hasn't gone anywhere since, in 12 months, right? In 12 months, it hasn't gone anywhere. So I don't know if you've ever heard, you know, the longer the base, the higher in space. I believe I said that on last week's webinar. So it has just been consolidating in a really tight fashion. It's got a 4.7% dividend, but I don't typically care about dividends. Just because they can get wiped out in a day with an ugly move. But look at the accumulation. So here's what you want to look at when you're looking at an extremely long consolidation. Here's the one thing I look at. When I like to see it go from wide to a little bit tighter. And even though it's really hard to tell, I think it's trying to squeeze itself in here within this consolidation. All right. So you want it to kind of go from wide and loose just a little bit tighter. And then you want to see accumulation within the consolidation on the right side. So, which you see right here. Now, this is an ETF, so this isn't like an individual stock. But my point is, this is looking like it's going to break out. And, you know, it really confirms what everything that, like last week, maybe kind of the bearish tone. Last week, I gave you CubeSmart. I gave you CubeSmart, and this is, if you look at it, the earnings aren't really that great, right? It's not exciting fundamentals. It's just a REIT. But look, it broke out. It kind of got this reversal right here, but look at the accumulation. Now, that was last Friday when I shared this with you, and the stock hadn't looked back. So you're probably going to have a lot of these REITs start to make a move when these institutions are probably getting a little bit more bearish on the market. I wouldn't say bearish, but just a little bit more cautious. Money's going to flow into these REITs. So you got the Vanguard REIT that's looking like it's got some accumulation. You have this REIT that has gone straight up, you know, since last week, and lots of accumulation. That is not your grandma up the street buying shares. So it's just, again, one more collective evidence point to say maybe the market needs to take a breather for a little bit. Now, I've been talking about oil and financials because, again, I like the move in. I like to get in early in the move, and you have the banks that broke out of this and are now testing this downtrend. You had a lot of accumulation right here, but it's starting to look a little ugly this week. And the reason it's starting to look ugly is because the Treasury yield has really gone straight down for 2 weeks, and that's going to affect the banks. Now, is it just going to roll back over, or is it just going to, you know, continue to consolidate for even longer? Like, this consolidation is 39 weeks, but really it's been a year since it's gone anywhere. And you got accumulation on the right side. So I'm really keeping an eye on Treasury yields to see if banks will turn it back around. Let's just kind of look at a bank. I'm not saying this is the one, but man, look at all this accumulation. That is a lot of accumulation right there from this move to this move. Even while it's consolidating, there is accumulation. You got failed breakout, successful one. Now it's retesting this pivot zone right here. But again, I'm paying attention to the accumulation in these long consolidations. If you start to see that on the right side, that's where you need to pay attention. When I look at charts, I look, I go through hundreds of charts, you know, during the week and on the weekends. I start right here. I see, is it too far advanced for me to want to get in? Then my eye goes down here. Where's the accumulation? If it looks ugly, I'll pass. And then third, I'll look at the fundamentals. So if this passes, I'll go down here. If this passes, I'll go over here. So price, volume, fundamentals. All right, I want to look at a couple other stocks that I've emailed you. If you open your emails, Cabot Oil and Gas, it looked really good. It had the weekly upside reversal, and I sent that to you a couple weeks ago. Had a weekly upside reversal right here. It's broke out, came back, tested support, and then it's popping again a little bit today. So this is another stock that really hadn't gone anywhere. You know, a long consolidation. That's kind of an ugly drawing, but you get my point. And then look at this long consolidation, and then it tightens up, and look at that accumulation. Something worth paying attention to. I also been emailing you a lot this week on Cheetah Mobile. Chinese mobile software developer and application. Pretty good fundamentals. I'm not really crazy about the return on equity, but you had this weekly upside reversal right here. You got the volume spike, and then, so I sent that to you on Monday, and then on Wednesday, yesterday, the stock popped 26% on some, news that some other company put $50 million in it, a partnership agreement. But, sometimes, and you don't know which one's going to do this and which one's not, but, some of these are really worth paying attention to, especially if you start to see the accumulation. So when I send you these emails, you might want to take a look at it and see if it's the kind of stock that you would invest in. Because I'm not saying I can get it right all the time, but sometimes I'm pretty good. All right, so I want to show you two stocks, and then we're going to look at the Chinese IPO market. I just kind of want to give you some, let's look at Twitter for a second. Again, I like to look at stuff that's early in the move. Twitter popped in a big way. Look, it's going to have year-over-year acceleration, right? Return on equity. It's got slowing sales growth, so maybe it's going to turn that around. But, it had this pop right here. And that pop is 18% on the 26th of 715% above average volume. Broke out of this consolidation and is now pulling back beneath the pivot, shaking people who bought this breakout. It's shaking them out right now. But definitely for my members, that once that happens, what it's doing is it's coming down, it's testing that 20-day moving average, is coming up to follow the price action, and now it's sitting on support. So, I don't know if I'm just all over it, because it has popped so many times within this consolidation and rolled over. But if you like Twitter and you don't know when to get in and haven't tried it yet, I would say this is a better, as good as opportunity as any of these other ones, just because it broke out in massive volume. I mean, it's not your grandma's buying it. Shaking people out who bought on this day, shaking people out, but it's holding the first moving average under the pivot. So a lot of times if you buy, this is why it's dangerous sometimes buying the breakout, because what it's going to do is it's going to pull back and it's going to kiss that first moving average under the pivot, and then it's going to find support, and that is your true entry. Another one that looks very similar, if you just like American names, is kind of what I'm going for right now. What is Skechers? Okay. Skechers looks very similar. Looks ugly forever. Look, it hasn't done anything. It tried to break out right here, failed, tried to break out, failed, and now it popped in a big way on earnings. It was up 40% a few weeks ago and triple the volume, but look, it's starting to ease back a little bit. I believe it will find support at the 10-week moving average. So it's looking right now. It's sitting on the 20-day. So if you think the market is not going to correct, I think this would be a decent entry. But man, that's a lot of gap. And why that's probably not a trade for me, but it might be a trade for you, is I always like to look at something and say, okay, where am I going to get shaken out? Like, how is the market going to take my money? And I typically don't like to invest in something, 10% max, but I really like to be in that 5 to 6% range. So how much is it going to cost me to find out if I'm wrong? And I think for me, it would cost me, this is it'd be a 15% drop to these moving averages, which would be the next major test of support. So if you like buying 20-day bounces, that might be a good one. For me, it might be a little too steep, but we'll see. Okay, let me get a drink of water real quick. The final segment of the webinar is I'm gonna cover some the Chinese IPO market, and I'm doing this, and we're gonna look at some lessons, and I want to make sure that you're not playing this stuff. I want to make sure you don't get hurt. So you got JP, right? This finance investment management company. 13 companies have came public. 13 Chinese companies have came public in the U.S. this year, most of them being since September. So it's a lot of these are starting to pop. Now, this isn't a one-year IPO, but if you see my webinars before on Chinese stocks, like what happens is they can be dormant forever, but once they wake up, man, they can go very quickly. Like this stock is up 143% from this top of this dotted line right here. So, you know, why I like playing Chinese stocks like this is because I want to get in right when this happens. I don't want to sit through this. I don't want to get in up here. I want to get in right here, okay? So I try to find rules that is going to keep me in. If we want to look at another one, I'm just going to look at a couple of examples of the kind of stocks that we want to own. You got this China Internet National Law Firm, CIFS, solid return on equity. Pretty good sales, but this is a micro cap. For some odd reason, it trades at 1.5 average volume. It's trading about 220,000 shares a day. But look at this. This stock did nothing. It IPO'd at 10 and it traded sideways, and then it woke up and it's up 257% since it broke out. Okay. So again, when these stocks start to break out, I want to hold them. But so what you want to do with these is if you get hold of one, if you're lucky to get a hold of one, you want to find a profit target that takes profits on the way up for your first target, and then you want to use the 20-day moving average as your second stop. So with your remaining shares, use the 20-day moving average. Now I do that on high flyers because they can get way, way above. So if I were to use the 50-day moving average, I mean, that's a long way from grace right there. It's a long way to fall, and I don't want to give that much back. So, but it's interesting how this stock is quadrupled 5 times, and it hadn't even broke the 20-day moving average yet. It's still above it, which is just insane, absolutely insane. So again, a lot of these IPOs, and why I think here's why I think more of these could continue. One, these companies are growing, right? I know there are a lot of U.S. companies that grow, but man, there's a lot of growth in online China right now. And two, like a lot of them have been extremely undervalued relative to the rest of the market. Like I'm talking, and I don't normally pay attention to valuations because I don't care. Because I just follow the price action. I don't care if it's 500 PE or 5, but when I just noticed like a lot of these Chinese stocks were just selling at under 10 when I could see Amazon selling for 200 and they're growing faster than Amazon, I'm just like scratching my head. So I pay attention and I have lots of them on my watch list. So let's just go out and look at some. Now again, you want to be careful and you want to be cautious. So if I look at this, there's really no buy signals. Like it popped and then it just went into a straight downtrend. There's no buy signals whatsoever anywhere in this downtrend. No breakouts or anything that would have gave me the confidence to jump on board. Then it broke out of a downtrend and it came down and it tested the 20 and 50-day crossover and then went, at 53% or more than that. Here it's actually popping today. 13%. So, something's wrong with this stock. So I don't know if but it popped today on earnings, and I haven't even read this earnings report. But it popped on earnings, but something that goes from 12 all the way back to 7, man, I don't know if that's something I want to be involved in, but I want to let you know how quickly these things can move. But also, I'm showing this as a warning sign. Don't get involved in something where you don't have clear exit strategies. Or even if the breakout doesn't work and it rolls over the other way, you want to make sure that you have an exit strategy. 10% max, don't give it 20, because if it goes 10, it's probably going to go 20, because that's just how they are. So let's look at some new ones. So you have RYB Education. This is interesting. It's up 9% today, and it's starting to spike a little bit. So here's what I wanted to show you. What happens with a lot of IPOs. And this isn't just Chinese IPOs. This is all of them. They pop up and they do this little double bottom. So then they snap back and then they undercut. They undercut the previous leg and then they turn around and come back. I always wait for that second undercut because I love IPOs. I don't trade them on the first day. I don't trade them on the first week or even in the first month. I like to wait for this pattern to happen. But what these stocks are trying to do is they're trying to figure out what kind of stock they want to be, right? They're still trying to figure out the personality, and only, Wall Street, they determine that. And it shows up on the chart. But, you want to wait for that undercut. You want to wait for that second leg down before you have confidence. And maybe you buy it as it crosses back here. And I realize that's a long ways to go. But at least you are giving yourself, the rules so you aren't buying this first dip. Because if you'd have bought this first dip, man, even though it came back, it might not have. So this RYB education is kind of looking interesting. Pretty good return on equity, really good increase year over year in fundamentals. Sales are looking pretty strong too. So this Chinese education market, I mean, we all know that, the Chinese, their culture, I mean, they invest in their kids' education. That's without a doubt. So, it's just kind of something interesting. And I'm just noticing, you got this Zito. Look at this accumulation right here. You got year-over-year acceleration, decent return on equity, great sales. So, I mean, the fundamentals are there in some of these stocks. And look, if we look at this, it popped right here on the IPO. It took a leg down, popped back, and then it took another leg down. So, I'm saying it's just, I mean, if you got a strategy for trading same-day IPOs, great. I'm not interested. But all I'm trying to show you is when these stocks come out, you definitely want that second leg down. And then when it starts to come back, see if it'll create a consolidation and take a leg higher. I might have bought right here. I might have bought right here because it popped, it came down and created a consolidation, then it broke out. But it didn't happen, right? So then I would have been stopped out right here. And that's just how volatile these names are. So if we look at Yentech, now this is a stock I've made money on twice this year. I bought, let me see. So you have what I call the no news pop in some of these Chinese stocks where they just pop and there's no news and it's like a 8 to 10% pop. Could be more, could be a little less, but you look for the volume. And then they're off to the races. And we bought right here. Actually, I think it was right here. And it popped like 20%, and then it came down and crashed through. So we made like a few points earlier this year. But look at what happened, and I'm just trying to show you why you don't want to buy and hold these things unless it's on the north side of the moving average. Then I just patiently waited. Then it broke out of this downtrend right here. This was the day that we bought it. The subscribers bought it, and we took some profits up here, and we took some profits right here, and now we don't own it. But look, it's going to break out or it's going to break down, one way or the other. Now, it reports in 4 days, so I don't go buying this beforehand. But, I'm showing you these can be incredibly powerful if you play them right. And I'm looking at these every day, and some of them, like, I don't think my emotions can hold. But I try to invest in companies that make sense to me, and then the fundamentals are there to back it. So this best BSTI, I got stopped out of this one. We got stopped out of this one. This was one we traded, but man, I'm considering getting back in it. Look at these sales. I mean, look, it went from 200 million in sales one quarter to 2 years later 700. I mean, it's going to be that's a $1 billion company. That's in a quarter right there. Look at the sales growth. So this is a transportation logistics, and these are logistics company. And these are all Chinese, by the way. But look at what it did. It came down, kind of a little leg, and then it came down and undercut it, and then it popped. I think we bought it right here, and it was an early entry, and it popped, and it looked like we were good, and then it took another leg down. So we got stopped out right here. We got stopped out at 1060, and it stopped at 1050 and came back. Now I'm looking at the $12 mark to see if it can, you got a little W right here, a little double bottom outside of the first couple weeks. And I know it's sloppy looking, but I mean, the sales are there, and now you just got to wait for a technical event for it to happen. Now, the downside of this is look at the volume. So you got on the 2 up weeks, and this is worth noting, is very, very light volume compared to the down weeks. So maybe I might wait a little bit to make sure that I at least get some big daily volume spikes to give me the confidence in something like this. Another education company, Rise Education. Look, one leg down, pop back up. It's looking like it wants to take that second leg down. Maybe wait till it crosses back above the middle. So as you can see, volume drops off after the first couple weeks because it needs to settle down. But again, you don't need to buy any of this stuff before it reports, so just make sure. And I'm walking you through these to show you how profitable they can be, but just how you want to make sure, you know, some of the mistakes that you want to make sure you don't make. Like QD, this is another one, very solid return on equity, triple-digit sales growth. Pretty good sales earnings per share, even though it decelerates from 400% to 50%. I don't typically like deceleration, but, you know, let's keep our eye on it. So it popped at the first leg, and it's coming up. So I'd be watching for that second leg. You see I have a little dot here. I'm going to see if it gets back above this, and then I'll start to pay attention. Dragon Victory, again, like it's on its first leg. It IPO'd at 8. It came down. It's trying to come back. You got to wait for something else to happen, a consolidation or something, before getting into some of these. And I know they're hot. I know I don't hear too many people talking about them, but you know, the IPO market's definitely hot. So don't go picking anything. You got SEC Limited. Again, isn't it interesting how these all, from a chart standpoint, they all do the same thing? Look, leg down, leg up, looks like the leg is coming back down. I mean, we just looked at 10 charts and almost all of them did the exact same thing. So if there's a lesson to be learned today, and I know these are Chinese IPOs, but in any IPOs, you know, if you're looking to get involved, you can almost always get a cheaper price than trading, you know, the first day. I'd wait for the first leg to come down, wait for the second leg to come down. And if the leg doesn't undercut, that's okay. If the leg just goes right here and then it crosses back above here, that's really probably your best entry if you're looking to get in early. If you want me to notify you of some of these stocks that we trade, you can take a trial somewhere. You know, there's a button. But let me know if you have any questions. I hope this was helpful. I hope you have a great weekend, and we'll talk soon.